there is this one single question that I've been receiving so many times that I have already lost count. And this question is this: Hey, Beyond, is XYZ a good stock? And I'm sure that you have come across that question somehow before. And every time I had to stop myself from giving a straight yes or no answer. Because if the truth is, even if I said yes, what would that be based on? And so, after investing for over a decade, I have come up with a 5 filter checklist that I use myself to go through before buying any company. And in today's video, I'm going to share it with you, and also why most people who already know these 5 things still mess up their portfolio. So let's get started. Now, let me start off by sharing with you a personal case study that I experienced. So it is about this company called Wirecard, and you can see the word in big: Germany's biggest scam. So back in 2020, this was a very big deal, right? So I remember that this was back in June 2020. It was a Friday afternoon, and I was in an investing group in WhatsApp, and I received this message that says, "Hey, Wirecard options are giving super good premiums right now, options premiums." And at that point, Wirecard was one of the largest payment processor in the world. It was listed in Germany. Wherever you go, you can actually see that payment processing system. You get the receipt that says Wirecards. And suddenly they were under huge accounting fire. However, they were still trading. And the options premium that they were giving is very, very juicy. And I did what I now call the worst form of research, right? I read just enough to confirm what I already wanted to believe, that it was a big company. It must be good. I see everywhere. And the institutions are holding it, big companies were holding it. And I already decided that I wanted to get in on this stock. And everything after that was just me trying to validate and hunting for permission. And days later, Wirecard admitted that $1.9 billion in euro on its balance sheet did not exist. And within that week itself, it went bankrupt. And all my trades went to zero. And it was because of this experience that led me to create these 5 filters, starting with the first one: do I actually understand this business, or am I just impressed by it? Now, the first filter is the most basic one, but it's the one that almost everyone feels on a hot stock, right? So just read the question out loud and let it sit for you for a little bit. And let me share with you what I mean with a real story from a student. So there was a student of mine who was holding a small cap AI company that ran up 70% in 2 months. And I actually asked him, hey, do you know what the company does? And what he shared was that AI infrastructure. Right? And I pressed further, and he didn't actually know what they sold, who bought it, or how they made money, who were the customers. And when it dropped 30% the following week, he actually panicked and sold at the bottom. Not because the business broke, but he actually never really understood it in the first place, because there's a very big difference between I read about it and I actually understand it. So, this is what I call the 60-second test of something that you can ask yourself before you invest in any company. Okay, so this is the test that I developed. Number one is, can you explain how this company makes money to your mom in 60 seconds in plain English? And if I can't do it, it just means that I don't understand it enough and I have no business buying it. Because when you understand a business, red days will feel very different because you will know what will have to break for your thesis to actually die. Now, the second filter is this: is this mode real, or am I just looking at the current chapter of the company? So, what does mode mean? Mode means the competitive advantage of the company. What makes it very, very different? Now, let me explain. Every mode has an expiry date, and I'll use some companies so you'll be able to understand it better. For example, Kodak. Right, Kodak had a mode. They actually ruled photography for decades, and when digital photography came up, it disrupted their business and it erased their mode entirely. That is the first one. Second is Nokia. Right, Nokia, something most of us will be familiar with. They dominated mobile phones globally, but when smartphone came out, the iPhone came out, the BlackBerry came out, it changed their whole game overnight. And the third one is Blockbuster. Right, Blockbuster was actually a video rental giant worldwide, but when streaming came out, Netflix, for example, it actually eroded their mode to zero. Now, moats or competitive advantages are always visible right up until they are not. And the biggest question that you want to ask yourself is this: it's not does the company have a competitive advantage, but what would have to happen for their competitive advantage or their moat to disappear? And is it already happening quietly somewhere that you're not looking at? So let's use something that is closer to home, right? In Singapore, for example, Singapore telcos. 10 years ago, there were three big players, right? Very regulated, in a regulated market, very sticky consumers, predictable dividends, and it looked very permanent, right? These three telcos, who are they? Singtel, StarHub, or M1. And then we started to see them getting commoditized. We see MVNOs coming out and pricing power quietly evaporated from 2 years fixed contract plan to now a SIM only plan where you can just cancel the next month. Right? Nobody saw a cliff. The moat just eroded one quarter at a time, and all pricing power, it just became a price war downwards. So the moment you assume a moat is permanent, you will stop watching it and you start to get complacent. And that is the exact moment where it actually kills you, because this kind of thing can creep up very, very quickly, as from all the examples that we saw. Now, the third filter is this: does the management treat shareholders like partners or like ATMs? Now, most investors don't look at this, but it's actually one of the highest signal filters of all, right? Watching what management does with their own money, that will actually tell you everything. Now, at the Berkshire AGM this year, the new CEO, Greg Abel, actually announced that he was putting his entire after-tax salary, 25 million, to buy company shares, right? And he even said it every single year for as long as he's the CEO, right over here. So that is him tying his personal wealth to the same outcome that you as an investor is betting on the company. And you compare this to a CEO that is paying himself in huge cash bonuses, diluting shareholders through endless stock options, and secretly quietly selling his shares every quarter. Same title, but it's a completely different game that is being played. Now, that is also why you don't just want to trust the investor presentation that comes out, because investor presentations are always written in a way that makes the company look good. What you want to trust and look at is how management have allocated capital over the past few years. That is the track record that we want to see. Look at how they are doing with their own money, and that will actually tell you how they will treat shareholders' money as well. Now, moving on to the fourth filter. Do the numbers tell the truth, or am I cherry picking the ones that fit my thesis? And in fact, from my case study, from my own experience that you saw earlier, this was the one filter that I failed. Okay, so let me show you exactly how this trap works and how you can avoid it. So this is what I felt with Wirecard. I decided that I want in, and then I went looking for the numbers that supported it. Now, the honest version is to first look at the numbers that argue, that goes against your thesis. For example, the revenue growth is slowing, cash flow do not match reported profits, or insider selling, auditor changes. In the case of Wirecard, it was a report from the auditors. Or another point is with the debt is rising faster than the earnings. So most investors actually do the opposite. They look at the bull case first, then look for the data to support it. So this is what we call confirmation bias dressed up as research. So this is the habit that you want to develop that will actually break this confirmation bias loop. Right, before you buy, write down the three numbers that will tell you that the thesis is broken. Right, not just the revenue growth, looking at their cash flow. How much cash are they burning, right? How much profits do they have, right? And see that somewhere visible. Watch the numbers, how the companies have grown against them. For me, when I check Wirecard's cash flow against their profit, right, the cash flow did not actually tie with it, right? But I did not actually look at it, which caused me to make this mistake. The last filter is this, and this is the hardest, because the thing that excites you about a stock might be the very thing that you should be the most suspicious about. Are you buying the business or are you buying the story? Now, let's go back in history to look at how the world has changed since the 1920s. That is actually still relevant today. The first off is cars in the 1920s. At a moment in time, it was a revolutionary thing, right? And the next thing that we saw in 1999 was internet stocks, right? And at that moment, the story always seems very real, and the technology always does change the world. But the price that you pay for that story at that moment in time will actually decide whether you make money from it. So in the 1920s, in terms of car, one of the biggest company then was Ford Motors, right? Their stock actually peaked in 1920 because the car transformed civilization. However, investors who bought at the peak because of the story, they actually waited 40 years to break even, right? And including the internet bubble, right, in 1999, right? If you look at all of these companies, some of them are not even here today. Pets.com, they actually went up on a high and they all went bankrupt without any cash, without any profits to back for it. So the question to ask yourself before you actually buy any company is that if the company delivers exactly what they're promising, but it took 5 years longer and the stock went sideways for 3 years on the way there, would this be something that you will buy and hold? If the answer is no, then simply put, you are just buying the story, not the business. Now, these are the 5 filters that I run through before I decide to go deeper to look into any company. But there is one important thing that most people miss, which is that on top of it being a filter, it's not just a simple checklist where you check all of it. It is actually a mirror. A mirror to who? It is a mirror to yourself. Now, these 5 filters are not stock filters. They are what I call attention filters. And the real important work is not just running through the list. It is actually noticing the moments where you want to skip one of these filters and forcing yourself to ask it anyway, especially on a stock that you have already fallen in love with. Now, this is one of the biggest mistakes that many people make, falling in love with the stock. But remember that the stock don't know anything about you, right? You shouldn't be attached to a stock. If the thesis has broke, if you know that you're not buying this because it is fundamentally strong, that you believe in the business, then there is no reason for you to buy it. So before you open any single chart, before you start reading the news and following what people are saying that this stock will go to the moon, ask yourself, run it through these 5 filters and ask yourself which one of it are you most likely to lie to yourself about with these specific stocks, right? There'll always be one of them. The other four might be easy, right? The hardest one is the one that you actually don't want to ask, right? And that is the one that matters the most because the market do not reward the smartest analysts, do not reward the smartest investors. It rewards the most honest one. And honesty is harder than it sounds when you have already made up your mind on the stock. That's all that I have for you for this video. If you do enjoy this video, be sure to hit that like and subscribe button down below. And if you think that this is something that could benefit a friend, be sure to share it with them as well. And I'll see you in the next one.